Positive news has been in limited supply around the world this last week. The US has overtaken China to become the country with the largest number of coronavirus cases in the world. The US now has 83,000 cases, a 70,000 rise over the last week. Combined cases for EU 28 countries also stands at 220,000, with Italy at 80,000. The immediate and savage economic impact has also started to become more obvious within high-frequency data. US initial jobless claims surged from 282,000 in the previous week to 3.28 million in the week ending March, setting new records for the increase and the level. For a historical context, initial claims data starts back to 1967, and the previous record increase was in July 1992 at 172,000, and the all-time high level in 1982, 695,000. So 3.28 million is a truly shocking update, emphasizing just how significant the economic and social costs will be to the US. However, global markets have adopted a more upbeat tone this week. We've seen a broad arsenal of credit and liquidity support, quantitative easing, loan guarantees and income assistance programs being announced around the world. On Thursday, the US Senate approved a massive $2 trillion stimulus package to try to pop up the ailing US economy. The 96-0 vote in the Senate showed the level of support from US lawmakers to get ahead of what is becoming both a medical and solvency crisis. The bill will go to the US House later today, and once passed into law, we'll see checks in the mail worth up to $1,200 per adult earning less than $75,000 per year, $250 billion in expanded unemployment benefits, $350 billion small business loans, and $150 billion of support for state and local governments. Now, expectations that the bill would quickly pass helped US equity markets to 3 days of back-to-back gains, with the S&P 500 up 17% over that period and up to 20% up from the lows, retracing about a third of the losses seen over the last 4 weeks. The US dollar has also weakened as central banks have pumped hundreds of billions of dollars into global markets. The expanded US dollar swap lines that are being offered by key central banks around the world has helped ease pressures in so-called foreign exchange basis swap markets. These complex markets reflect the ebb and flow of demand for US dollars in derivative markets. FX basis swap markets are suggesting that near-term demand for the US dollar is waning, and this is arguably one factor behind the drop in the US dollar in recent sessions. Now, turning back to the economic impact, next week we get some important US data updates. On top of the weekly US initial claims data, we'll get March reads for the ISM PMI on Tuesday, which is expected to drop back to GFC lows. We also get March US non-farm payrolls on Friday, and that is expected to show a drop in US payrolls of over 100,000. Now, here in Australia, it's some time before we start to see economic data for March being released. Data next week includes February credit data on Tuesday, February building approvals, as well as March house prices, and the minutes of the RBA's 18th of March emergency rate cut on Wednesday. We also have February retail sales on Friday too. Now, that run of data may reflect the lagged impact of the bushfires, the drought and travel bans that came into effect in February. However, they will predate the government's attempts to contain the virus that came into effect in March. However, survey data is beginning to show the impact of the shutdowns, and consumer confidence dropped to levels last seen in 2009, according to the NZ survey. Our economics team has slashed its Q2 GDP forecast to minus 3.5% for the quarter, and then minus 0.3% in Q3, sending the unemployment rate to 11%. Now, we've seen some wild swings in the Australian dollar this last week, which is understandable given global developments. From a low just above 55 cents on Wednesday last week, the Australian dollar surged back above 60 cents this morning, helped by improved risk sentiment and a falling US dollar. That sharp drop in the US dollar has lifted other currencies too, with the Norwegian kroner up 12% from record lows seen in chaotic trading just 1 week ago. While the Aussie dollar has recovered back above 60 cents today, we'd caution that commodity prices have not bounced in line with equity markets. Iron ore prices have traded below $85 this week, and liquid natural gas prices in Asia have dropped towards historic lows as an extreme glut has developed. With ports in Asia being impacted by the virus, the risks of Australia's commodity exports are rising, and this should limit upside for the Australian dollar. Now, regular viewers will note that this wonderful backdrop is not our usual location. Given the social distancing requirements, we've taken the option of heading outside to one of Sydney's best harbour vantage points. While the audio quality may not be as good as usual, we hope that the stunning views will offset and that we'll be able to find another just as stunning location for next week's markets update.